One thing that's so interesting is what we're seeing with jobs data from yesterday. ADP and Moody's Analytics put out their own private payroll numbers, and they were oddly positive in the sense of only 2.8 million jobs lost in May, that is to say, versus an expected 9 million jobs lost. That was the anticipated number. That's why it's good, because it was only 2.8 million compared to 9 million anticipated. Well, Kevin Hassett, one of the senior economic advisors to the Trump administration, was Fox Business yesterday, and he was asked specifically about these numbers, and he was a little puzzled. Take a listen.
Until we reopened. And the way to think about it back of the envelope, Maria, is for every week that the economy shut down, you lose about 2% of GDP, but not at an annual rate. And so if you shut down for a month, then that's about 8% of GDP, and then you multiply that by 4 to get what happens when they put out the GDP release to put it at an annual rate. And so we shut down really hard for a month, but now we're starting to open up. And I believe that it's going to be very, very possible. Again, if you look at it, we're not seeing a wave of bankruptcies. We're not seeing a wave of defaults because of the PPP loans and all the cash that we put in people's pockets. Yeah. And so that we can turn this thing back on. And whether we do or not is something that we're just going to have to wait and see the data. But again, this ADP report is a real positive sign, and it's such a positive sign that I really have to grab my pencil and go back to my desk and see what's going on, because it's way lower than I expected.
A head scratcher, so positively lower. But then today, weekly jobless claims totaling 1.877 million last week versus a 1.775 million estimate. Total claims rising to 21.5 million, meaning we are slowly getting workers back to work. The stock market's down a little bit today, although it's been rising the past few days. What are the dynamics at play? What are investors keeping in mind? And then what about some strategies and opportunities? We will talk about all that more with Phil van Doorn, who rejoins us here on Jimmy at the Crossroads. He is investing columnist and analyst at MarketWatch and joins us now. Brother Phil van Doorn, welcome back to the show, my friend. It's been a while. How are you?
Doing okay, Jimmy. How are you?
I'm doing pretty well given everything that's happening across the country and so forth. And I'm grateful for how things are going for me. It could be a lot worse for sure. And how about you?
Same thing. Very grateful. Something occurred to me with that clip that you just showed, the TV clip. I don't remember the gentleman's name, but he made a good point. Even though he showed that it's difficult to have a back-of-the-envelope discussion on the fly, the point was a good one. The second quarter GDP decline figure will be exaggerated because it will be annualized. So I agree with him in that respect. So you're going to have a very ugly number, which could drive some ugly market action when it comes out in July. That said, I think the stock market is showing that investors are pleased with the extraordinary efforts of Congress, the president, and the Federal Reserve to shore up the economy.
And one thing, at the very least, is that some aspects of our economy have been relatively stable in part because of some of that support. Now, the idea of growing back very quickly, that's up in the air. I mean, nobody has any real clue about how quickly the recovery will be, Phil.
If you have laid off a dozen people, you will not be hiring a dozen back instantly. You will be cautious and bring them back slowly when you see that you absolutely need to have them as your business recovers. So I agree, it will be a slow recovery.
Now, Phil van Doorn, one thing to keep in mind is how investors have been looking at all of this. I mean, the past few days, we've seen the stock market on the rise. Today, down a bit. What do you think is on the minds of investors more than anything at this point?
Well, money needs a home, and interest rates are very low if you're looking at the bond market. So there are income seekers who are looking to the equity markets in various ways to wring out additional income. And we can get a little bit further into that with an example if you want. But I think investors are thinking long term. Why else would the market have recovered so quickly and so significantly? Investors are realizing that life will return to normal. There have been plagues and terrible outbreaks of viruses before, even if we haven't had a big one recently. It's happened before, and life has gotten back to normal, and it will do so again. That's what people are thinking.
The thought process makes sense in that regard, but at the same time, Phil van Doorn, it is also the case that we've had the economy shut down because of government policies, and now in various cities across the nation, you have untold property damage that is significant. A lot of businesses that were ready to reopen are going to have to wait weeks, if not months, to begin that reopening process. How much do you think that could adversely impact the economy as people try to get things going again?
I don't know. I don't have any numbers.
Yeah.
You know, we can focus on specific images from violent events, but I do not know the scale of the damage that has been done through the violent acts over the past couple of weeks. So we've had those before as well. Maybe not, certainly not within living memory for most of us, but you had lots of rioting in 1968. There have been other cases of this. So I think that investors believe that the U.S. economy will shrug this off as well.
Phil van Doorn, so when investors are looking at the dynamics that are in play right now, is there anything you think that they're ignoring that maybe that is not top of mind? And then we'll get to a few of your stories.
They might be ignoring true diversification of their holdings. I looked just today at day end numbers through June 3rd, and at that time, 5 stocks made up 22% of the S&P 500. The S&P 500 is weighted to companies' market values. So all millions of people who put their money in index funds through retirement accounts at work are very heavily concentrated in Apple, Microsoft, Alphabet, Facebook, and Amazon. So they are not as diversified as they might think. So they might consider different types of investment vehicles to broaden their horizons a little bit. They also might think about certain income producing investments instead of only growth investments. And many people have financial advisors, and they should open up discussions with them and try to broaden their horizons by asset classes as well as within the stock market.
So, Phil, when we look at the index fund dynamic that you're talking about, I mean, there are different ways where people can invest in a whole bunch of stocks as opposed to just picking an individual company, you know, Apple, Netflix, whatever it is, and investing in that way. And some have expressed concern about that, going to your diversification point, concerned that too many investors are putting their eggs in one basket or too few baskets, that maybe they think they're diversified because they're in one of these funds or an exchange-traded fund, for example, but maybe they may not be as protected against some of these volatile dynamics that are in play as they should be. What do you think?
Age of a young investor with many decades to go should be less concerned about volatility than an older investor who may have to start drawing income from his or her nest egg within a few years. That's part of it. Your own risk tolerance is part of it. But depending on whether this money is in a retirement account or not, why not consider other things? You can consider what about owning a rental property, for example? Then you're no longer tied to the stock market, and money is coming in every month, assuming that your renters are able to pay. Within the stock market, I've been looking at some closed-end mutual funds, which are designed to provide income. They can be complicated, but depending on the fund, you might get a yield of over 6% at this time, which is quite significant when you consider a 10-year treasury bond pays you around 0.7%. There are also closed-end bond funds that mature within only 1 or 2 years, meaning the fund ends within that time. You can buy those at a discount, enjoy an above-market yield, and have that yield and the gain because of the current discount when it matures in a short period of time. With those investments, you might be looking at 7 or 8% annual returns with almost no risk, at least compared to the stock market. So I just think it's a good idea to consider broadening your horizons. See what's out there, and if you need help, talk to an advisor, hopefully one whose fees aren't too high, and broaden your horizons.
So let's talk about the T. Rowe Price Capital Appreciation Fund, one of your stories of the last handful of days, Phil. It looks like this one guy has got a fund that's performing pretty well.
This was something of a human interest story. One of my readers pointed out the next day that the fund is closed. So you can't even put money into the fund unless you're already a shareholder. That means that I failed in my research before we published the story.
Phil.
But it also it had a human
brother.
interest angle. The fund manager narrated what it was like to go through the stock market crash in February and March, and how he put $9 billion to work during that time. So he mentioned 16 stocks he either bought or added to in the tunes of hundreds of millions of dollars on a day-by-day basis as the crash occurred. So I think it's a fascinating story. It's called What It's Like to Buy $9 billion in Stocks During a Market Crash. I would check it out. It is fascinating. It's easy for him to be buying when everybody else is selling, but he admitted that he had trouble sleeping at night. So I think that your listeners may find this story interesting.
Yeah, so in other words, it's an example of how somebody was able to take a bad situation and get through it pretty well.
It helps that he's managing $57 billion.
Only a little bit.
And that he was sitting on a mountain of cash at the end of last year. He thought the stock market was valued too high, so he just happened to have all this cash on hand. But he said that's the way he runs this fund. It tends to take advantage of down markets and load up at that time, and be much more conservatively run when the market is higher. So it's just something to look at, because it can also help you broaden your thinking as an investor.
Again, we're talking with Phil van Doorn, investing columnist and analyst at MarketWatch, joining us here on Jimmy at the Crossroads. So you also have a story about John Bartlett. He's with the Reeves Utility Income Fund. And one thing that I always like about a lot of the stories that you focus on is there are different strategies that investors put into place in order to be effective at making money, and whether it's an income-focused opportunity or they're trying to navigate difficult waters like we've got over the past few months economically and what have you. So what is this fund doing?
Well, first of all, this fund doesn't try to navigate the economic waters. It's very specifically focused on providing monthly income to its shareholders. And it does so by investing in utility companies, which they define very broadly. It's not only electric and gas utilities, it's communications companies such as Verizon as well. But the manager, Mr. Bartlett, focuses on companies that are building out their infrastructure. For example, where I live in Florida, Florida Power and Light is vastly expanding its electric grid and improving the electric grid so that it can recover more quickly after power outages from thunderstorms, hurricanes, and tropical storms. He explained, and it's in the article, how those investments lead to higher profits for regulated utilities because the regulators are involved in the investment decisions and, in effect, come close to guaranteeing that earnings will increase as the investments are made. So it's very, very industry specific. And backtracking to the closed-end fund industry, this fund has a yield of around 6.5%. Actually, it went down to 6% because the stock went up over the last few days. So it has a yield of around 6%, which is very attractive. There are other closed-end funds out there which may be paying 10% or more, but you have to be careful. There are esoteric details in this class of investment that you must learn before jumping in. You and I can get into more detail if you want, but listeners can read the story. It's called This Unusual Income Fund, has a dividend yield of 6.5%, and has beaten the S&P 500. This fund beat the S&P 500 for 5, 10, and 15 years, which is incredible for an income fund. The reason is the managers are going for capital gains each year, which are distributed as part of the dividend. They harvest those gains at the beginning of the year so that they're ready to pay out the monthly dividend all year long. So it's good for income investors and for long-term growth investors, or at least it has been over the last 15 years.
Let's explore for a moment this idea about how this fund and others, there are other funds out there that don't try to navigate the shall we say, choppy economic waters, that they're not making day-by-day decisions, that are making these kinds of adjustments. That kind of goes to a question that we've often talked about here on the show with you, Phil, and that is about following the headlines or ignoring the headlines. Talk to us a little bit about how some of these funds, of course you just talk about one's approach, but how other funds may look at the idea of trying to navigate economic waters versus let's just keep steady with a very particular plan. This is what we do. This is how we're going to continue to go about it. How common is this idea of, shall we say, just the steady path versus we need to make adjustments?
Well, there are many even passively managed funds that follow a steady path. For example, today we covered the ticker is SOXX. So that's S as in Sam, O, X-ray, X-ray. That's the iShares Semiconductor ETF. It tracks an index of 30 companies that make computer chips or the equipment used to manufacture them. It is much more volatile than the S&P 500, but it has tripled the performance of the S&P 500 over the past 5 years. So you are going to go through much more painful declines with this group, and it will not be adjusted based on what's going on in the economy. But the rewards have been there because people keep buying more and more devices that need the chips. So it's a group that's constantly innovating. As a group, sales grow faster than they do for the entire stock market. So over various long-term periods, it keeps beating the S&P 500. So that's a passive approach you can look at. Then again, semiconductors are used in many different industries. There are much more narrowly focused ETFs that only focus on one industry. I looked at one yesterday, JETS, JETS is the ticker. It tracks airline stocks. As you could imagine, it's had some blowout days recently. If you're a day trader and you think that the economic news is going to keep improving, you might be looking at ETFs of that type. It's up 9% only today. Shares of American Airlines were up 25% only today, last time I looked. So whatever kind of investor you are, there are vehicles for it. I am not a day trader, and I'm not well versed in that style. But JETS is a typical example of how you can place tremendous bets that can enable you to make a quick killing or lose your shirt.
Let's talk about different sectors and how they've been performing just for a moment. Anything catching your eye? You mentioned airlines for a moment. We've been seeing them struggle the past few months, understandably so, when people have not really been able to travel. So very few have been on airplanes. Unusual for the United States, very unusual. I don't think we've seen anything like it except since 2001, that time period with September 11th. But any other sectors that are sort of catching your attention?
Well, everything is up tremendously since the market bottomed on March 23rd. As we speak, I'm trying to pull the figures for the airline industry, just for the heck of it, and the cruise industry.
That one, I forgot about the cruise. Yeah, absolutely. The cruise industry, it's interesting because that was a hotbed for the spread of this virus in the beginning, in the early days, with the Princess cruise ship and so forth.
One can argue that the airlines are a more important industry because you will be compelled to visit your loved ones, but you're not compelled to go on a petri dish cruise.
That's true. Yes.
So since the bottom, the hotel, resort, and cruise line group of S&P 500 companies is up 53%, and the airlines are up 34%. So I sit corrected. Then again, the cruise lines may have gone down a bit more than the airlines before that. Looks like they did. They crashed more. Anyway, it depends how we look at this. If we look since the bottom, energy is the best, up 72%, because they had the double whammy of the oil price war. The massive production increase when demand was subsiding. Materials follow suit. That's up 51% since the bottom. Everything's up tremendously since the bottom, but consumer staples is up the least, 22%, and then energy tops. As far as what sticks out to me, healthcare always sticks out to me because we all need it. and the population around the whole world is aging. So again, it depends on the time period.
Now, also, of course, tech has gotten a lot of intrigue and interest in recent years, but especially in the past few months, if people have turned to, and tech-related sectors. So when I say that, I mean, sure, Apple and Microsoft, for example, but also Netflix and some of those kinds of companies. What are we noticing going on in that space, especially because anything you've noticed in that regard?
Well, you always have high-flying stocks based on fads. Now, I'm not saying fad in a bad way, but Zoom
Yes.
is incredibly popular now. So it's not a fad, it's a trend. And that one has popped. And I can't tell you if it's overvalued right now. I'd have to take a very close look at the numbers. So you always have something like that. The next good thing or something new that does a better job of providing a service that others were already providing. I've spoken to people using Zoom who say it works better than Skype. They say it's easier to maintain the quality of the video and there are less dropped video calls, so they love it. So Zoom is a success. But I pointed out the semiconductors because our increased use of streaming, cloud computing, collaboration over the web, video conferences, all that stuff requires the use of computer chips.
And
So
chip
I like the
stocks.
broad exposure.
So talk to us then about chip stocks. Seems they're flying pretty high, although investors still finding some bargains.
Yes, so that's why I mentioned that one. We have the greater volatility. At any time, the chip stocks look expensive. At almost any time, they look expensive when compared to the entire S&P 500, based on how high the stocks are going. But also, the price to earnings ratios sometimes look very, very low, as they typically do for a company such as Micron. But anyway, I like the SOX 2X's ETF as a way to play 30 chip makers at the same time. And if you can tolerate the volatility, it's been a wonderful long-term investment. Looking within those 30, analysts' favorites include Micron, which I mentioned, Applied Materials, Qualcomm. They expect plenty of upside for these stocks over the next 12 months from here, despite the recovery for the sector and the broad market since the March 23rd low.
Phil van Doorn, again, our guest, investing columnist and analyst at MarketWatch. So I'm pleased to have you on today to be able to go over some opportunities, especially as people are, I think, feeling a little bit more comfortable about the economy and where it's headed, especially because of the reopening. But at the same time, I want to ask you the question. I alluded to it before. I ask you every time you come on just because you always give a slightly different answer. But at the same time, it's the same fundamental point. What do you tell people who are looking closely at the headlines and following headlines when making decisions sometimes, as opposed to maybe ignoring the headlines on a regular basis and making investing decisions?
Well, let me skirt around your question a little bit and tell you, I spoke to, in my business, we talk to public relations representatives all the time. And I spoke to a young one who helped me with an article, and she said, "I've saved up some cash, and I want to open a brokerage account and start investing. What stocks should I buy?" So I started by telling her, "I have no idea what stocks you should buy." But as we spoke, I realized that the most important message for her was to focus on controlling your expenses, because if you can get your expenses in line and balance out your financial life and start saving cash, when you get started, your savings will grow faster than any investment that you can make. So advice number one is control your expenses. Number two is start saving cash for the things that you need that you know are coming up, and to make investments slowly and steadily over a long period of time. Make broad investments if you are a novice investor. If you are a professional investor, you don't need my help. If you are a day trader, what does that mean? Have you just started day trading? Then you better start small, because you need experience in order to understand when to add and when to sell, when to take your lumps and sell at a loss, how not to sell too early, how not to wait too long before selling at a profit. All that stuff requires requires experience. So I worry about novice investors, and I want them to learn what they're doing before they lose their shirts. And for long-term investors, diversify, do your own research if you're buying individual stocks, learn to have faith in the company you're investing in, or don't buy that stock. And then if you have the faith, keep the faith for a number of years.
So heed that advice and do not just make rash decisions based off of the headlines. I'm going to throw that answer into the question as well. Phil van Doorn.
You did a better job than I did.
Thank you. Hey, no, that you gave
Thanks,
some
Jimmy.
great insights there. Always good to talk with you, my friend, Phil van Doorn.
Thank you. All the best.
Best wishes and stay healthy.
Thanks.
Thank
you too. Bye-bye.
Again, Phil van Doorn is investing columnist and analyst at MarketWatch, joining us here on Jimmy at the Crossroads. You know, a little bit of a divergence. We haven't talked too much about nitty-gritty, sort of stock market and investing and some of the dynamics that are happening right now. There are opportunities. The economy's improving. Jobs numbers, not as bad maybe as we were expecting. Maybe things will start picking up. We will have to see. You just watched a clip from Jimmy at the Crossroads. Don't miss more engaging, intelligent talk. Subscribe to the Jimmy at the Crossroads YouTube channel today. You want to catch our live show. And I love your support.
I got Jimmy at the Crossroads, making sense out of no sense. Yeah.